Hello everyone, welcome back to the Wealth for You channel, where we help Singaporeans become cash flow rich, not just paper rich. Today we're diving into a headline that's got investors buzzing, and it's not just any news, it's from DBS, our very own local banking giant. That's right, according to the Edge Singapore article titled STI could rise to nearly 10,000 points by 2040. Dated 22nd October 2025, DBS is predicting that the Straits Times Index, or STI, could triple to nearly 10,000 points by 2040. From around 4,400 today, that's a massive potential leap. Now, before you start picturing your Sentosa retirement villa or those kopi-sipping days fully funded by dividends, let's take a deep breath and unpack what this really means for us as Singapore income investors. Because here on this channel, we don't chase hype. We build steady cash flow, long-term wealth, and financial peace of mind. So stay tuned till the end of this video, because I'll break down why DBS is so bullish on Singapore, what's happening globally with the US markets, Fed rate cuts, and gold prices, how dividend investing fits into your long-term plan, the key risks to watch out for, and how you can position yourself for the STI 10,000 era. If you find this kind of Singapore-focused content useful, give this video a thumbs up so more Singaporeans can watch it, and subscribe to Wealth for You to join our community of cash flow investors. Just a quick disclaimer. This video is for education and general information only. It's not financial advice or a recommendation to buy or sell any investment. Always do your own due diligence or speak to a licensed financial advisor before making any investment decisions. All right, let's jump in. Chapter 1. Why is DBS so bullish on Singapore? So, what's behind DBS's big optimism about Singapore's market? It's not just wishful thinking or marketing hype. It's built on solid economic data, structural tailwinds, and what I like to call good old-fashioned Singapore resilience. Let's start with the basics. Singapore's economy may not be the flashiest in the region, but it's one of the most consistent. Even through global uncertainty, our GDP growth has remained steady, driven by strong exports, services, and a growing financial sector. And when the economy keeps humming, corporate profits, especially from our blue-chip companies, rise over time. More profits mean better dividends and higher share valuations for investors like us. It's slow and steady, but as every Singaporean knows, that's how the tortoise wins the race. Next, let's talk about the three musketeers of our market: DBS, OCBC, and UOB. These banks aren't just local lenders. They're regional powerhouses expanding across ASEAN and Greater China. DBS notes that Singapore's financial institutions are perfectly positioned to ride Asia's rising wealth wave, from Indonesia's growing middle class to the increasing number of ultra-rich in Vietnam and India. And as global rates ease, banks will also benefit from renewed loan growth, rising fee income, and stronger investment activity. In short, more wealth, more deposits, more lending, more dividends. Now this part, every dividend investor will love. After a few painful years of high interest rates and declining valuations, our beloved REITs are finally poised for a comeback. As rates begin to drop, financing costs ease, and investor appetite for stable income returns. Valuations rise, yields stabilize, and confidence rebuilds. It's not just a rebound, it's the start of what could be a REIT renaissance. Think of it as Singapore's version of spring after a long winter, the yield season returning in full bloom. And here's the secret weapon: trust. With ongoing global tensions, shifting supply chains, and rising uncertainty elsewhere, Singapore shines as a beacon of stability. We're politically neutral, economically sound, and strategically located, right at the heart of Asia's trade and capital flows. When global investors look for a safe place to park their money, Singapore stands out, not just as a financial hub, but as a reliable partner. So yes, DBS's forecast isn't just random optimism. It's a reflection of Singapore's trusted formula: strong institutions, disciplined governance, resilient companies, and, of course, strong kopitiam coffee to power through every market cycle. That's the Singapore way. Steady, dependable, and quietly powerful. Chapter 2. U.S. Markets, Fed Cuts, and the Gold Rush. Now, let's zoom out. Because what happens in the U.S. doesn't stay in the U.S. When Wall Street sneezes, even our kopi money here in Singapore feels the chill. Across the ocean, market strategist Tom Lee from Fundstrat has turned quite bullish. He believes the S&P 500 could hit 7,000 by the end of the year, setting a brand new record high. And his message to investors? Don't get distracted by the noise, whether it's talk of a U.S. government shutdown, stubborn inflation headlines, or political drama. He says the long-term fundamentals are improving, and that's where the smart money is positioning. But here's the real game changer. According to Reuters, the U.S. Federal Reserve is expected to cut interest rates twice more before year-end. Now, why should that matter to us, sitting here in Singapore with our kopi O in hand? Because when the Fed starts cutting, it signals the start of a new global liquidity cycle. Money begins to flow again. Borrowing becomes cheaper, companies expand, investors regain confidence, and risk assets, like stocks and REITs, usually come back to life. We're already seeing early signs of this. Global bonds, after 2 painful years, are finally recovering. One analyst called them a wonderful cushion for balanced portfolios. And it's true. Bonds are once again helping to smooth out volatility for long-term investors. And then there's gold, the shiny metal that everyone has been talking about. It surged to over $4,200 per ounce before plunging sharply in a single session. With production costs hovering near $1,500, many analysts now say gold may be overbought. Some investors are already taking profits and rotating their capital back into, you guessed it, income assets like REITs and dividend-paying equities. So globally, the tide is clearly turning. The Fed is cutting, bonds are rebounding, gold is cooling, and that combination usually signals a market shift back toward yield-generating investments, the very thing Singapore does best. In short, the world is quietly setting the stage for the comeback of income investing. And for Singapore, a market built on strong banks, high-quality REITs, and steady dividends, that's music to every investor's ears. Chapter 3. Your CPF-like investment strategy. All right, let's bring the focus back home, right here to Singapore, where the art of dividend investing is practically part of our DNA. Now, for newer investors who may be wondering, what exactly is dividend income investing, and why do so many Singaporeans swear by it? Let's keep it simple. When you buy a share, you're not just pressing buttons on your trading app, you're owning a slice of a real business. And when that business earns profits, it can choose to reward you, the shareholder, with a portion of those profits called dividends. Think of it like being a landlord, except your tenants are profitable companies. You're collecting rent, but without the midnight plumbing calls or chasing late payments. Your only job? Hold quality assets and let them pay you. The beauty of this approach is that it builds a steady stream of income that grows over time, almost like your very own CPF life payout, except this one's powered by your portfolio, not the government. And here's the best part. You're in control. You choose the companies, you decide when to reinvest, and you get to watch your dividend checks grow year after year. And Singapore? We're spoiled for choice. Our STI is packed with reliable dividend champions, the banking trio, DBS, OCBC, and UOB, paying out consistent dividends backed by strong profits. Singtel, the defensive telecom giant that's modernizing its business for the digital era. Keppel Corp, a diversified powerhouse evolving from offshore rigs to sustainable infrastructure. And of course, our famous REITs, which pass rental income straight from tenants to shareholders, making you, in a sense, a mini landlord of offices, malls, and data centers across the region. Every quarterly or half-yearly payout you receive is one more step towards freedom. A little more Kopi money, a little more peace of mind. That's why for many Singaporeans, dividend investing isn't just a strategy. It's a lifestyle. Because at the end of the day, it's not about chasing the next hot stock. It's about building reliable, recurring cash flow that lets you live life on your own terms. Chapter 4. Risks and Your Action Plan. Now, before we start shouting STI to the moon, let's slow down for a reality check. Because smart investors don't just ride on hope, they plan with eyes wide open. And every long-term bull story, no matter how exciting, comes with its own set of speed bumps. So, what are some of the key risks ahead? First, there's the global recession. If the US or global economy slips into a slowdown, Singapore, being a small open economy, will feel it first. Our exports, logistics, and manufacturing sectors are tightly linked to global demand. When trade slows, corporate earnings and dividends can take a temporary hit. That's why resilience and patience are key. Income investors must expect short-term noise in exchange for long-term rewards. Then there's geopolitics. Tensions in the South China Sea, the Middle East, or between the US and China can cause global uncertainty. And when uncertainty rises, markets pull back, even those as stable as Singapore's. But here's the thing. These shocks often create buying opportunities for patient dividend investors who focus on quality and cash flow. Now, don't forget about China's recovery. China remains one of our biggest trade partners. A slower recovery there can affect our banks, REITs, and tourism-related businesses. But over the long run, China's structural shift towards domestic consumption and regional trade still benefits Singapore's position as a trusted hub for capital and logistics. So how should we prepare? First, stay the course and think long-term. 2040 is still 15 years away. That's enough time for multiple bull and bear markets. Don't panic over short-term price dips. Focus on consistent compounding, dividend reinvestment, and time in the market, not timing the market. Remember, it's the patient investors who collect the most Kopi money in the end. Next, diversify wisely. Don't let your portfolio depend on one sector or one market. Balance your exposure, a mix of banks for growth, REITs for income, and maybe some global ETFs or bond funds for stability. Bonds are finally making a comeback, acting as a safety cushion that protects your capital during downturns. Also, rebalance regularly. When your REITs or bank stocks rally strongly, take some profits and redeploy into undervalued areas. Think of it like trimming your durian tree. Pruning keeps it healthy and ensures better fruit next season. And finally, focus on quality and yield. In uncertain times, quality always pays. Stick to companies with strong balance sheets, sustainable earnings, and consistent dividend histories. They're the ones that will lead the STI's journey toward 10,000 and reward investors along the way with steady income. At the end of the day, the road to STI 10,000 isn't about chasing the next big winner. It's about owning reliable cash flow machines that survive every cycle and keep paying you, rain or shine. Stay disciplined, stay diversified, and remember, in Singapore's market, time and dividends are your two strongest allies. Chapter 5. The Singapore Dividend Investors Roadmap. So, will the STI really hit 10,000 by 2040? Well, no one has a crystal ball, not even DBS. But if you look closely, the pieces are falling into place. Singapore's economy remains one of the most stable in Asia, anchored by world-class banks, disciplined governance, and reliable dividend-paying companies. Falling global interest rates are setting the stage for renewed growth. a tailwind for REITs, bonds, and income-focused investors everywhere. And honestly, from DBS and OCBC to Singtel and CapitaLand REITs, the STI is packed with businesses that don't just grow. They pay you while you wait. Put all that together, and you get more than just a forecast. You get a roadmap to financial independence. Because every dividend, every reinvestment, every patient year compounds quietly in your favor. So stop stressing over daily price swings. Focus on building monthly cash flow. Let time do the heavy lifting, and let Singapore's resilience work for you. At the end of the day, remember this simple truth. Being cash flow rich beats being paper rich, every single time. If you found this video helpful, give it a thumbs up so more Singaporeans can watch and learn how to build sustainable passive income. And don't forget to subscribe to Wealth for You, your go-to channel for dividend investing, CPF strategies, and cash flow freedom. Okay I'm off to grab my bowl of soup and check my dividends. Take care, stay invested, and I'll see you in the next one.